Well, kia ora, and welcome to the kaka to Paul Conway, the Chief Economist at the Reserve Bank and a member of the Monetary Policy Committee that decided last week what to do with the official cash rate. Paul, great to see you.
Kia ora, Bernard. Nice to see you as well.
So what did we find out from the Monetary Policy Committee, which you're a member of, and what did the Reserve Bank come up with in its fresh set of forecasts?
So first set of forecasts for 2025, we ended up, to cut to the chase, I guess, cutting the OCR by 50 basis points, so that got it to 3.75. If you want to get into the details of the forecast, inflation is back pretty much at the middle of our target band, our 1 to 3% target band, so it's sitting in around 2%. We're expecting growth to pick up in the economy this year. Obviously, last year was a big sort of recession in New Zealand for Q2 and Q3. GDP data last year was around 1% negative for both those quarters, which is significant, highly significant. And we're picking growth of 0.3 in Q4 and then sort of up into the 0.5, 0.6 sort of range over the course of 2025 and into next year. In terms of unemployment, we think we're around sort of peak unemployment in the labour market. So we do see the labour market turning. Normally that takes some time. There's a bit of a lag there. Businesses sort of need to know that growth is persistent in the economy and likely to hang around before they start to employ people. So second half of this year, we see the labour market employment growth picking back up and unemployment dropping off from its 5.1, 5.2 sort of peak where we're going to be at over the next couple of quarters. So long story short, we are well on the way to returning interest rates or the OCR to what we call the neutral interest rate, which is neither stimulatory or contractionary in the economy. Inflation is showing all the signs of we're reasonably confident that we've got headline inflation around that midpoint. There's still issues with domestic inflation, which in Q4 last year was still elevated. Fortunately, it's been offset by negative tradables inflation, so inflation coming over the border, which has sort of given us the confidence to cut interest rates. And as we can't sort of bank on tradables inflation coming over the border, we do see that increasing. It's been negative the last couple of quarters, which has been great. But essentially that's giving us scope for those domestic inflationary pressures to continue moderating and become consistent with overall inflation in the middle of the target band.
So you're looking to push the official cash rate back down to neutral, around about 3%. That was the plan too in November, but what's different in your projections? Now, that's not a promise, that's a projection. What's different in your projections in February versus November?
Yeah, essentially, they're pretty close. The change in our OCR forecast is, it's not huge. Essentially, it's around the committee. And I really want to stress we are a committee. It's not one person making these choices or these decisions. It's 7 people who are getting really strong briefings out of the economics department and more broadly across the bank here. But essentially, we've got increasing confidence that those persistent bits in our inflation are returning to normal, if you like. We're getting through that post-COVID cycle that we're seeing in the economy. Everything is broadly evolving as anticipated, and that's giving the committee confidence to bring forward that easing that we had already been communicating, in fact, since July last year. And overall, we have done 175 basis points of easing in a little over 6 months. So, yeah, we're well into our work.
Just looking at last year and particularly GDP, because there's been some fairly big revisions, which sometimes makes it difficult to work out what's actually happened. Can you tell us, what's gone on with those revisions and why there was such a big drop in GDP in Q2 and Q3?
Yeah, so the GDP numbers, they do they typically get revised in the Q3 when we get the Q3 data, and that certainly happened this time around. So GDP over the last, 2 and a bit years was revised quite significantly, and the impact of that was that growth in this economy was much stronger over 2023 than the first estimates of GDP led us to believe. You'll well remember that growth over that period, according to the initial estimates of GDP, was very, sluggish. And there was even a recession or two in there, a technical sort of 2 quarters of negative growth, and they're not huge, but a bit below zero, so fitting that technical definition of a recession. You'll also recall, Bernard, it was a challenging time for us because we were still, early 2024, we were still seeing significant widespread domestic inflationary pressures in the economy, and it was a bit of a puzzle to the bank and to the Monetary Policy Committee because, according to the data, economic growth was, slow to negative economic growth in the economy, but we were still seeing inflation pressures. And then from the middle of last year, Q2, I think the original estimate for Q2 GDP was negative 0.2. That got revised down to negative 1. And then in Q3 it was negative 1.1, or it might have been the other way around. Sorry, I can't recall. But so the bottom line of all that is that we had a significantly stronger economy in 2023 and into 2024 than the data originally led us to believe, and a much deeper contraction or recession in the economy over Q2 and Q3 of last year. And I should say, that revised data, it makes more sense to us in terms of explaining inflation dynamics in the economy. So some of those head scratches that we were experiencing, they sort of go away a bit based on this new data. Obviously, it would have been nice to have that at the time.
Mm. So what actually caused that quite deep recession in Q2 and Q3? Sure, it's true that monetary policy was quite restrictive, but it can't all have been monetary policy, could it? Can it?
I mean, we're obviously doing a lot of work on this. We're sort of doing a sort of mini, what we call RAFIMP. Every 5 years we do a review of monetary policy settings over the past 5 years, and we're kind of gearing up for that and doing a bit of practice on the disinflation that this economy has just experienced. A lot of it was to do with monetary policy, so bits of the economy that are particularly sensitive to monetary policy or to interest rates did contract over that period. So, construction and retail and the like. And it sort of, makes you think about, the sort of long and variable lags of monetary policy. So obviously we'd put up interest rates, well ahead of that. But you sort of get to a point where they really start to bite. And I think that was in the middle of last year. Of course, there were other things going on. The electricity prices were incredibly high over that period. And, indeed, there were some big employers that shut up shop over that period. And I think, there were bits of the manufacturing sector that did at least restrict or lower their production over that period, given the, very high price of a critical input into what they do.
I'm curious about inflation as well. The Reserve Bank's supposed to focus on inflation and achieve somewhere between 1% and 3% over the medium term. But there's different types of inflation that we see in the economy. Some of it comes straight from overseas, not much we can do about it, fuel prices, that sort of thing. Some of it's, locally generated inflation. It's firms who put up their prices because A, they can, and B, they've got higher costs that they want to recover. And then there are administered prices. You've got the government and various other players, maybe monopolies, who can just do it. So I'm curious, in box B of this month's or this quarter's monetary policy statement,
Mm.
there's a very interesting analysis of the different types of inflation: low sensitivity inflation, as in not very sensitive to monetary policy; medium and high sensitivity. I'm
Yep.
curious about that low sensitivity stuff, the administered stuff, the stuff
Yep.
where the Reserve Bank, can't really have too much of an immediate impact.
Yeah. So this is for stuff like so what we've done here, just to sort of lay it out. We've looked at the different components of CPI. We've done some econometric wizardry to see how sensitive they are to interest rates, to changes in the official cash rate. And we've sort of categorized them into three categories: those that respond or that are very sensitive to monetary policy, which is stuff, like retail, trade, construction, et cetera, et cetera. They respond, or demand in those sectors responds very quickly to a change in monetary policy, so that flows through into prices, and then through to middle level responsive, and then into slow to respond. And this is things like insurance, energy, administered prices, which is rates and other sort of taxes, and things around the place. And consistent with that categorization, what we've been seeing from sort of in 2023, really, since as we were getting through our work in terms of hiking interest rates, it has been those sensitive bits of the CPI that were fast to respond. And they're actually around where they would normally be now, inflation in that category of product, that category of goods and services. Whereas the mid and the slow to respond, they are heading in the right direction, but with a significant lag there. So, it is happening, but it's happening very, very slowly. So these are things like, there's a lot of inflation persistence there. It doesn't sort of matter as much where interest rates are. Obviously, local government, for example, they can change rates. They're not all that sensitive to what's going on with interest rates, and we're absolutely seeing some of that. I should say, it's normal to have relative price shifts in the economy. So it's not unusual for us to have a few items in the CPI where their prices are moving around, quite significantly, given what else is sort of going on in the sector. But now the fact that a lot of that sort of energy in the CPI has sort of settled down, the tide's kind of gone out. So it's becoming increasingly apparent, where those persistent inflation pressures lie within the CPI basket.
I'm interested in the administered prices, particularly local government fees and charges, government fees and charges. And I wonder whether some of that inflation we've seen is not what you'd call normal inflation in the prices of goods and services, which the Reserve Bank can focus on, but is actually a type of capital charge as governments catch up on previous underinvestment in capital, or look to shift the capital cost from government debt to maybe local government debt or private debt. And in effect, you're seeing some inflation in capital costs bleeding into the consumer price inflation index. Now, the Reserve Bank specifically is not doesn't focus on capital costs or capital values. It doesn't respond to a big shift in prices of houses or stocks or anything. So
No.
is there a risk here that you're having to respond to a type of inflation which is a one-off shock, a structural shock, and which actually is not really consumer price inflation, it's capital inflation?
Yeah, like I definitely think that's a thing. Like I guess rates is the clearest example of that. I live in Wellington. Rates have gone up significantly, even though our house prices have fallen by a quarter. So there is a sense of councils catching up across the country, and certainly here in Wellington. So rates are catching up, just given depreciation in the capital stock, in our case the pipes, and associated infrastructure. I think you sort of hit the nail on the head there when you said one-off. Like ideally they are one-off, and if they are one-off, then that's a relative price shift. Going on for a particular reason, council sort of fell behind in terms of paying for depreciation and keeping capital, the quality of capital where it needs to be. And we can debate whether or not that's ideal, and they should have been sort of more on the button from day one. But from a monetary policy perspective, as long as they do stay as one-off, then that's fine. They sort of have their effect on overall CPI. They pass through. They don't get incorporated into people's wage demand. So we're not getting people sort of overreaching on pay beyond productivity growth. And they don't get incorporated into firms' pricing decisions and sort of getting into that sort of price-wage spiral territory. And we're not seeing any evidence of that, thus far. Quite the opposite, really. I think, a year or 2 years ago, when we had a serious inflation problem, inflation was sort of 6-7%. The committee was way less accommodating about those types of charges, because in that environment there's a chance that they do feed into that generalised price and wage pressure. With inflation at 2.2%, we're our negative output gap is significantly negative. So the productive capacity of the New Zealand economy is significantly above where the level of sort of aggregate demand in the economy is at the moment. So it's not the sort of business environment in which firms will go, oh, my rates bill's gone up, therefore I'm going to charge people more for my product, and off we go into a spiral. I think the MPC, the Monetary Policy Committee, is increasingly confident that we're not in that sort of world. So those relative price shifts, they can pass through, and as I said, that's normal. Of course, we remain very vigilant to the risk that they do bleed into more generalised inflation pressures. So we're not that relaxed.
Just thinking now about economic growth in the year to come, you're looking to see it start to recover through the rest of 2025. I'm just trying to get my head around where the growth is going to come from, because business investment seems quite weak. If anything, it's been falling, and you've downgraded your business investment forecasts in this latest set of projections. The housing market isn't really taking off, and perhaps the way some might have expected, a year or so ago. In fact, the Reserve Bank has lowered its forecast for house price inflation in the next year or two. Yep. And, the government is looking to, reduce some of its spending growth and some of its investment growth. So I'm just curious, where's the growth going to come from?
Yeah, well, it's the perennial question. Like we are seeing growth this year, but it's a cyclical pickup in the economy. So actual demand in the economy is going to increase towards our productive capacity. So, I made a speech a few weeks ago just sort of saying that potential output growth, effectively that's the speed limit for our economy. Like, yes, interest rates have been holding back demand in the economy over the last couple of years, as we've sort of got inflation out of the system. And the committee now is saying, well, we're well getting through that process, notwithstanding that domestic inflation in the economy is still too high, but it's coming down. So all our measures of core inflation are falling. Most of them are within the 3%, under the sort of top end of the target there. So we are easing up in terms of interest rates, which is allowing that cyclical pickup. So it's not going to be, interest rates are no longer going to be the constraint on growth in this economy. It's going to be things like productivity growth, essentially, or population growth, those things that feed into potential output. And I've written a lot about this, but I think traditionally we've grown this economy by sort of inflating the housing market and by growing our population at pretty high levels. I think for various reasons, that's not exactly optimal, and it's kind of gratifying that we are having the productivity conversation at the moment, because that is where longer run growth in this economy is going to come from. And from a monetary policy perspective, the best contribution that we can make to that is low and stable inflation. I would add, Bernard, and I don't know if you saw the Finance and Expenditure Committee session the other day, but there's plenty going on within the Reserve Bank that is relevant to that longer run growth conversation. So, access to the payment system, digital currencies, et cetera, et cetera. There's projects underway within this building that will help us improve that sort of dynamic efficiency within the financial sector, essentially around making the most of new technology. But it's not a monetary policy thing. It's that broader productivity conversation, of which the bank is a necessary part. But yeah, I think lifting productivity is a broader game than just what we can control within the RB here.
Perhaps luckily that's not in the mandate for the Reserve Bank. That sounds like a tough job.
Not that broader stuff, but in our financial stability stuff and other bits of our mandate, we can be pushing along that sort of dynamic productivity improvements within the finance sector.
Just finally, a lot of people who borrow against their home have fixed mortgages, and that's part of the reason why perhaps there's been a bit of a lag between the official cash rate changing last year and that's starting to be felt in people's pockets as they slowly roll off. Now, there will be quite a lot of rolling off in the next 6 to 12 months. I think more than half of the mortgage book.
That's a lot.
Yeah. But one of the things people might have expected is that as the official cash rate is cut, that there might be a return to the sort of mortgage rates that they had, maybe 2020, 2021, 2022. And back then, global interest rates, particularly bond yields, the ones that are the base upon which fixed mortgage rates are partly based, they haven't fallen back to where they, were COVID levels. So what are the prospects for all those people who are rolling off? Are they likely to see the big drops in interest rates that, they might have expected if we're going back to, quote, normal, whatever that is?
Yeah. Well, the COVID period wasn't normal. I think that's, really important. So monetary policy was extremely accommodative back then. The OCR was at 0.25%, and barring a humongous negative shock, such as a pandemic, where touch wood, not going back there anytime soon. So the other bit of that is longer term bond yields, both globally and in New Zealand. And they've been quite volatile, particularly in the US, which does sort of set the benchmark for the world. So a bit of fear in there that some of the policies of President Trump are going to be inflationary, which means that the Federal Reserve isn't going to be cutting rates as much as what it was intending to a year ago or whatever. And that is flowing over into the New Zealand bond rates as well. So they went up, quite significantly. They've come back a bit, and they're sort of bouncing around. A lot of volatility at that end of the curve as well. Like all that we can do, the governor makes the joke that we're holding a soggy noodle at one end, being the short end, and setting interest rates there with the OCR. And that is definitely leading to lower mortgage rates, at that short end of the market. And they've been relatively high, actually. And a lot of people were rolling off their mortgages and sort of going into shorter term mortgage tenors, thinking, that there's more interest rates to come before they would sort of commit to a longer term mortgage rate. But yeah, there's a sort of, I guess, to cut to the chase, there's a larger number of factors than just monetary policy that's influencing mortgage rates at those longer tenors. So yeah, it is a matter of just sort of weighing all that up and deciding. And I should also add, Bernard, sorry, like a lot of people are coming off their mortgages over the next 6 months or so, and this is the credit channel. That means sort of monetary policy will operate a bit more quickly because of that, but it's only one of the channels through which interest rates influence economic activity.
Excellent. Paul Conway, the Chief Economist at the Reserve Bank and a member of the Monetary Policy Committee. Thank you very much for coming on to the Kaka. Ka kite anō.
Thank you. Ka kite.
Cheers.